With Chapter 2, we begin to learn how to manage our money. The beginning of each chapter lists our learning objectives for the chapter. Learning Objective 1, identify the main components of wise money management. Number 2, create a personal balance sheet and cash flow statement. Develop and implement a personal budget. And number 4, connect money management activities with saving for personal financial goals. By far the most important one is number 2, create a personal balance sheet and cash flow statement. For those of you who've had basic accounting, these will be pretty straightforward. For those who haven't covered this in a business course, we'll go over it in detail in this chapter. The reason this is so important as it gives you a picture of where you are right now and provides a methodology to track your progress towards your financial goals. A basic definition: money management is founded on your day-to-day financial activities. Much like many diets direct you to keep track of everything you eat, to get a feel of where your money goes, do the same for every dollar you spend. Track it for a week or even a month, and you'll have a clear picture of exactly what you're spending money on and where you may want to change. There's a worksheet for this and several apps to help you track your spending as well. This graphic is from the text, page 45, and describes the 3 steps of money management. Number 1, having a plan for storing and maintaining your financial records. Number 2, creating that all-important personal balance sheet and cash flow statement. And 3, developing a plan for spending and saving. Starting with step 1, maintaining an organized file for your financial records is important. You definitely need them to file your taxes each year. Further, you need to keep records of financial transactions and your budget. This slide lists the whys of having an organized system of filing and storage, and they're really just common sense. Handling daily business affairs such as bill paying, planning and measuring financial progress, completing required tax reports, making effective investment decisions, determining available resources for current and future buying. Not all records need to be kept in hard copy paper form, nor do all need to be kept in your home. Items that you refer to frequently need to be readily available, such as tax records, your employment contract, credit reports, and investment records, for example. The question comes up frequently, how long to keep things? This slide lays it out clearly. Birth certificates, marriage license, Social Security info, forever. Property and investment records, as long as they're relevant. Real estate records, forever. Tax returns and supporting info, 7 years for sure, 10 is better. For many items, off-site storage such as a safe deposit box is a good option. Barring that, a fireproof safe in your home would be an alternative. Here you want to store records that would be difficult or impossible to replace. Birth and death certificates, marriage license, wills, military and citizenship papers. Notice that this also includes items you might need in case of a burglary or could be needed by your heir. Serial number and photo of valuables, CD and credit and banking records, insurance policy numbers. Small collectibles such as coins and valuable jewelry could be kept here as well. These are items you don't need to reference often, as it will require planning to go to the bank to access them. This graphic from the text just recaps what we just discussed on the previous slide. Most of us keep a lot of our financial records in digital form now. While easy, this raises several security issues. Important: back up your files regularly on external media. Use security software to protect your system from hacking. Use very secure passwords for all critical sites. If files are stored in the cloud, download and store copies offline periodically for added security. So what should you consider keeping on your personal computer? Again, the slide recaps the recommendations. Current and past budgets. This is where you keep track of your progress. If you bank online, as many do today, a full summary is available online. Just for security, you should download a summary periodically and definitely at the end of the year, if for no other reason than for tax purposes. If you use tax prep software, which I highly recommend and will discuss in Chapter 3, then your tax return will be on your computer. Definitely back this up to offline media. If you have an investment account, your account summary is also probably available online as well. Treat it like your bank data. Finally, digital versions of your personal finance documents, will, estate plans, etc. should be on your own computer. Again, this graphic recaps what we just discussed in terms of what to keep on your personal computer. Okay, we focused on what to keep. What about what to toss? Sales receipts for non-tax deductible items and expired warranties can be thrown away as long as they do not contain any credit card information. Any document which has any personal information on it should be shredded. Periodically, empty the recycle bin on your computer so any data deleted is not available to hackers. 4 very good reasons to create and update your personal financial statements. It shows where you are right now versus your goals. It measures your progress toward those goals. It tracks your activities, and it provides information needed to file your taxes each year. One of the 2 most important personal financial statements is your personal balance sheet. As I mentioned, if you've had accounting, this will be very familiar to you. For a company, this is called a balance sheet. For individuals, it can be referred to as a net worth statement. Basically, you recap the value of all items you own, all amounts you owe, and the difference is your net worth. This is very similar to the information a bank will require prior to granting a loan, such as a mortgage. So let's create a personal balance sheet. Step 1. List items you own in order of liquidity, as in a traditional balance sheet, but the categories are a bit different for an individual. Liquidity refers to how quickly an item can be converted to cash without a significant loss in value. Liquid assets include cash, checking and savings account balances, money market values, and the cash value of any life insurance. Real estate is clearly a long-term asset, and for most, its value will be offset by a corresponding liability in the form of a mortgage. Personal possessions include your car, stereo equipment, furniture, and jewelry. Investment assets include retirement accounts, mutual funds, and any investment account values. The sum of these is your total assets. Step 2. Liabilities look much more like their corporate version, current and long-term. Current liabilities are those that will be paid off within 1 year, medical bills and credit card balances, for example. Long-term liabilities would include your home mortgage, auto, and student loans. The sum of these, total liabilities. Step 3, your net worth, total assets minus total liabilities. This is Exhibit 2.2 in your text. If creating a balance sheet is new to you, you need to review this exhibit. Pay careful attention to where items are placed under each category. There are problems in Connect which require you to take a list of values and place them correctly in a balance sheet. As I already mentioned, your personal balance sheet is the one document designed to track your progress towards your financial goals. Our overall goal is to increase our net worth. Net worth is not a measure of available cash. It measures how much you would have left if you sold all your assets and paid off all your liabilities. Insolvency is defined as having liabilities that far exceed your assets, resulting in an inability to pay debt when due. Obviously, we want to avoid this condition, and monitoring your personal balance sheet is critical. Now that you have a better picture of how net worth is measured, it should be fairly obvious how to increase it. Increase your savings, increase your liquid assets, reduce your spending, decrease current liabilities, increase the value of investments, reduce the amounts owed. Like its corporate counterpart, a personal balance sheet is a snapshot in time as of June 30th, 2018. The other important personal financial statement is the cash flow statement, or a personal income and expenditure statement. This is a bit different from the standard corporate statement of cash flows, but the objective is the same. Where did your money come from and where did it go? Cash flow statement generally reflects a period of time, a month for example. An individual's inflows typically include net pay from employment, net of taxes and any other deductions, interest or income from investments, the proceeds from the sale of an asset. Outflows include 2 types of expenses, fixed and variable. Fixed expenses may include those which do not change month to month. Variable expenses are those which, as the name implies, vary month to month, and we'll look at those more closely on the coming slides. Creating this cash flow statement. Step 1. Records income from all sources, take-home pay or net pay, commissions, self-employment income, interest, dividends, gifts, grants, scholarships, government payments, pensions and retirement, alimony, and child support. If you get money, you record it. Step 2. Fixed and variable expenses. Fixed expenses may include rent or mortgage, loan payment, cable and internet, life insurance, home insurance. Variable could include food at home, food away from home, clothing, telephone, electricity and water, personal care like dry cleaning, cosmetics, medical expenses, recreation, gifts and donations. This is important since fixed expenses are exactly that, fixed. They must be paid each month. If cuts need to be made, they need to come from the variable expense list. Step 3, determine your net cash flow, surplus or deficit. This is Exhibit 2.3 from the text, a hypothetical cash flow statement for 1 month. Step 1, income. Step 2, cash outflows, fixed and variable. Step 3, determine your net cash flow and how you're going to allocate any surplus. The difference between income and cash outflows will hopefully be a surplus. If it's a deficit, then adjustments in variable expenses need to be made, and quickly. Assuming a surplus of funds, a decision needs to be made concerning their allocation. In this case, the surplus was allocated between emergency savings, savings for specific goals, and long-term savings. Once you create a cash flow statement for yourself and see what's coming in and where it's going, it's time to consider a budget to help you live within your income, spend wisely, move towards your financial goals, save for emergencies and long-term security. A budget is just a spending plan. This slide recaps the steps in order for developing a monthly budget. The first step is obviously decide on exactly what your financial goals are. Short term, you want to pay off all your credit cards. Medium term, pay off your student loan, save for a house. Long term, save for your children's education and your retirement. Once you have a clear idea of what you want your money to do, you can start working toward those goals. If you work at a, quote, regular job, one paycheck, then estimating your income for a month may not be too hard. If, on the other hand, you freelance or have various sources of income, this may be a difficult step. Notice that budgeting for emergencies and savings is high on the list. Pay yourself first. Fixed expenses come next as they have to be paid. Budget variable expenses, then record actual amounts each month to detect patterns for review and revision. Once you've done this for a month or two, you'll have a clear picture of where you may need to make adjustments. Budgeting is a circular process. Review and revise as needed, then back to step 1. Again, if you've had accounting, then using ratios to evaluate financial progress is familiar. For personal finance, we're only going to look at the 5 on the slide. The debt ratio, total liabilities divided by net worth. Lower is better. Current ratio, liquid assets divided by current liabilities. Higher is better. Liquidity ratio, liquid assets divided by monthly expenses. This indicates the number of months of living expenses that can be paid in an emergency. Higher is better. Debt payment ratio, monthly credit payments divided by take-home pay. Less than 20% is recommended. Savings ratio, the amount saved each month divided by gross income. 5 to 10% is the recommended minimum. Exhibit 2.4 in your text on page 55 offers some typical financial goals for 3 life situations. Single person, short term, finish college and pay off your car. Intermediate, vacation in Europe and pay off student loans and go to graduate school. Long term, vacation home and retirement savings. Married couple, no children. Short term, they might want an annual vacation and a new car. Intermediate, remodel their home and build a stock portfolio. Long term, build for retirement. A parent with young children, short term, increase life insurance and savings. Intermediate, increase investments, new car. Long term, larger home, save for college. Notice that providing for retirement is a long-term goal for just about everybody. Without children, goals can include vacations and new cars. With children, insurance and saving for college can take precedence. Exhibit 2.5 on page 56 in your text shows a sample monthly budget for a family. Note the steps followed as we outlined previously. Step 1, clearly state your financial goals. Step 2, estimate projected income. Step 3, budget for emergency funds and savings toward goals. Step 4, budget fixed expenses. Step 5, budget estimated variable expenses. Step 6, record actual expenses and variance to budget. And Step 7, evaluate whether revisions are needed based on a surplus or deficit. This is Exhibit 2.6 on page 57, and it gives some average budget allocations for 6 different family life situations. Student, working single, no dependents, couple with children under 18, single parent with young children, parents with children over 18 and in college, and a couple over 55 with no dependent children. Comparing your own expenses to these can give you an idea if you're spending too much in one category and what you should be allocating to different categories. Note that housing and food are large percentages for every category, with transportation a close second. A SWOT analysis may be a familiar term to those who have had principles of marketing. SWOT means strengths, weaknesses, opportunities, and threats. Companies use this type of analysis to focus on where they are, where they want to be, and what stands in the way. You can employ the same methodology to your financial planning. This sample SWOT analysis will show you how it's done and how to do one for yourself. Figure out what your financial strengths are: no debt, flexible job skills, and your weaknesses: high credit card debt, auto needs repair. Opportunities: apps to monitor your finances, part-time work, or threats: inflation, uncertain job situation. Okay, let's talk about a budget. A successful budget has to be well planned, and the planning has to be done by everyone involved. Realistic, based on the realities of your income and expenses. Flexible, you have to prepare for emergencies: new tires, new water heater. Clearly communicated. If this is a family budget, then everyone has to buy into it and agree to follow it. Budgets can take many forms, depending on the complexity and personal need. A mental budget may be just fine if the dollars involved are limited. A physical budget using envelopes or folders may seem old-fashioned, but it can work well to get started on a formal system. A written budget could be on notebook paper or accounting paper. Remember those green sheets? Today, there are a myriad of software programs specifically designed for budgeting. Alternately, you could just design your own using Excel. Whatever method you feel is appropriate for you and your family, the key is to get started and stick with it. Sample worksheets are available at the end of the chapter and are posted as Excel worksheets on Blackboard. We've covered the 3 basic financial planning documents you need to begin to manage your money and work toward achieving your financial goals. Your balance sheet tells you where you are financially at any one time. Your cash flow statement helps you track income versus expenses. Your budget details your plan and allows you to track variances to plan. The overall goal is to use your cash flow statement and budget to improve your balance sheet, increasing your net worth. So what will change your net worth? Now that you've seen what a personal balance sheet looks like, it should be obvious. If your outflows exceed your inflows, you spend more than you make, then you're going to have to draw on savings or up your credit card debt, either of which will decrease your net worth. If your inflows exceed your outflows, then you have money to save, invest, or pay off debts, increasing your net worth. The saving part is really important. As noted, everyone's financial plan should include savings for retirement, and it's never too early to start. No amount is too small to start. Remember the power of compounding. There are several ways to set up an automated savings plan that removes the temptation to spend the money. Writing a check to yourself every month is one method, but far better would be automatic transfers to a savings account or automatic deductions from your paycheck if your employer has a credit union. Dumping pocket coins into a piggy bank will add up, as will small savings on an ongoing basis, such as bringing your lunch instead of eating out, bringing your own coffee and skipping Starbucks. Whatever method you choose, make it a regular habit. If you're going to set up a regular savings plan, you should use time value of money computation so you can see how your money is growing. We've covered time value of money in the appendix to Chapter 1 with examples on using your financial calculator and Excel. Put these techniques to use to determine how much you need to save to reach your goals. Exhibit 2.7 in your text, page 62, shows the result of 3 savings plans at 3 different rates of interest. Admittedly, today investing at 7%, 8%, or 12% would be amazing since rates are closer to 1%, but it does illustrate the principle involved. Plan 1 is a simple lump sum of $6,000 invested at 7%. After 10 years, that amount has almost doubled to $11,802. Plan 2, saving for retirement, deposits $2,000 each year at 8%. After 10 years, this plan yields $28,974. Plan 3, savings for a home, deposits $200 every 3 months at 12%. In 10 years, this plan results in $15,080. In all cases, the power of compounding drives the growth. This actually completes Chapter 2. We're going to summarize our learning goals for this chapter. Learning Goal 1 was to identify the main components of wise money management. Organize your financial records and storage. Learning Goal 2 was the critical one, creating your personal balance sheet and cash flow statement. This is one of the most important steps in beginning to gain control over your personal finances. With any project, you have to know where you are now, balance sheet and cash flow statement, versus where you want to go and how you're going to get there, the budget. We covered the budgeting process as 7 steps, beginning with setting specific financial goals and ending with comparing your budgeted values versus actual ones to detect areas that need revision. For example, if you always seem to overspend on clothing and entertainment, then you need to decide which one will be cut back to adhere to your plan. Keep a clear eye on fixed expenses, as those are non-negotiable. You have to pay your rent or mortgage, like gas and water, and loan payments before anything else. The final step is connect your financial activities with savings towards your goals. Here's where using the time value of money methodologies can help you see how much you need to save or invest every month or year to achieve your goals. The last slides in each chapter are included for accessibility. They are designed to be able to be read by auto readers for visually impaired students.